Hello and welcome. So we are going to cover overview of economics. This is chapter 4. So let's start. So you get economic news from different sources. It can be from Bank of Canada, it can be from federal government, it can be from various newspapers, it can be from an international newspaper, or it can be from TV or internet. Now, understanding and interpreting this economic news is very important because economic news impacts your investment. So, whatever investments you have made in bonds, in equity, in real estate, all of these investments are impacted by economic news. So, to understand economic means what? So, to understand economic means to understand choices and how some of these choices affect an economy. To give you a perspective, whatever choices we make in day to day life as an individual and as a group, this is what impacts the economy. Example, if we stop buying real estate as an individual and as a group, then what would happen? The real estate market, which is a part of our economy, would be impacted. So whatever choice that we make to save, to not save, to spend, to not spend, all these choices impact our economy. So economics is understanding these choices made by individuals as well as made by big firms or governments. So understanding and interpreting these choices is economics. So once again, the definition of economics is the process of understanding the financial choices people make and how the sum of these choices determine what happens in an economy. Example is Netflix versus Blockbuster. So at one point in time, Blockbuster was a DVD and CD rental service. Okay, at one point of time it was huge. It had 80,000 employees, it had 2,000 plus retail location where you could rent DVDs or videos. But as an customer, we changed our choice from watching video through DVDs and CDs to watching videos through streaming services like Netflix. So as we changed our choice, it impacted the firm. So Blockbuster was was bankrupted, and the entire customer base shifted to streaming based medium. So whatever choice customers make, it impacts. That is why studying those choices is important. So why study economics? The performance of security market, both bonds as well as equity, is strongly tied to overall performance of the economy. For example, if you have invested in stocks of Apple, now if we go into recession and there is very high unemployment, so people will not have jobs. So as they don't have jobs, they would not buy the new iPhone that is coming. So sales of iPhone are impacted by the situation in the economy, whether it's recession or whether it's expansion. So Apple doesn't work in isolation. So as an investor in Apple, you are concerned about sales and profit of Apple, which are in turn impacted by the economic situation. So as an investor, you need to understand what is happening in the economy. A growing and stable economy over time has positive impacts on equity market. If you see countries that are stable, that are growing, and so these countries equity market generally performs well. So countries that are unstable, so there is a concept called as flight of capital. So flight of capital means capital goes to countries that are stable from countries that are unstable. So if there is some instability, there are civil wars, there are political uncertainties, then all these things impact investments. Bond market actively strongly tied to level and uncertainty of inflation and interest rates. So bonds are impacted by interest rates as well as inflation. So bond prices means a high level remark right now. Bond prices, we'll study this in fixed income when we go through fixed income, but bond prices are inversely correlated to interest rates. What does it mean? They're inversely related. So if interest rates are going up, bond prices go down, and interest rates are going down, bond prices go up. And this is for already issued bonds, not for new securities. I'll give you an example. So let's say when you bought the bond of, let's say, Canadian government issued bonds in 2017 when the interest rates was 5%. So you bought the bond at 5%. The bond is 30 years. The bond has a duration of 30 years. Now, if interest rates go down to 4%, what will happen? Since you have already bought the bond, you would still get 5%. You will not get the new interest rate, that is 4%. So you are benefited. So the price of bond has gone up. The value of that bond has gone up because this bond is paying 5% when new bonds are paying 4%. So value of this bond will go up. So bond prices and interest rates are inversely correlated. Same way bond prices are also related to inflation. So when we discuss fixed income, we'll discuss more about it. The economy has an impact on how many people work, how much they spend, how much product company sells, and how high inflation and interest rates will be. So all these parameters are impacted by the economic situation. So understanding this economic situation is important. These are factors that will determine investment return. So the bottom line is, whenever you invest in equity or bond markets, you are not in isolation. You are impacted by whatever economic situation is there in your country as well as globally. So there are two different streams of economics. One is microeconomics and another one is macroeconomics. So what is microeconomics? Microeconomics studies the interaction between consumers and firms. So interaction between, let's say, Apple and you. So Apple is the firm and you are consumers. So it is study of firms. It is study of small things. Okay. What does it study? It studies how the price levels create or lead to market equilibrium. So what does it study? That how much should Apple charge to a consumer so that it doesn't have any unsold inventory, as well as whoever wants Apple gets an Apple. So how much should Apple charge? For example, if Apple starts charging $5,000 for an iPhone, what will happen? A lot of people will not be able to afford an iPhone, so they will not buy it. So Apple will have unsold inventory. It will not be able to sell all its product. Similarly, if Apple starts charging $100 for an iPhone, what will happen? A lot of people will start demanding iPhone, right? So Apple will not able to match up the demand. It will not able to keep up with the demand, right? So a lot of customers will start fighting for fewer goods. So this is the aspect. So it studies interaction between demand and supply and what prices are necessary to match demand and supply. It also studies like a simple concept like why does price of bread go up? So questions like this. It studies the impact of minimum wage laws on supply of labor and companies' profit margin. So if minimum wage goes up, company's profit margin goes down as company has to pay employees more, as well as the supply of labor may increase. So if you are a discouraged worker, what is a discouraged worker? You don't want to work because you're not getting what you want from the economy. You're getting $10, $10.5 like in Alberta. But you know that living on $10.5 is so difficult, so you're a discouraged worker. You don't want to work. But if Alberta hikes the minimum wage to $15, what will happen? Some of these discouraged workers will start working. So, as the minimum wage goes up, supply of labor goes up. It will also discuss the entire favorite topics that are being discussed right now on various news channels: taxes on imports and impact on industry profitability. For example, US is trying to tax either of our agriculture production that happens in Canada, so whatever agro-based products we supply to the states, or it is going to tax automobiles that are produced and manufactured in Canada and then they are sold to the states. So it's trying to decide between both. Whichever industry it starts taxing, that industry will suffer a lot. So all these industry and consumer specific things are studied in microeconomics. Macroeconomics is opposite to micro. Macro means study of big things. So study of overall Canadian economy, not a particular industry, not a particular consumer. Measuring, so we discuss gross domestic product, gross national product, all these things in macroeconomics. How the changes in unemployment or inflation impacts in economic performance. So this is also what we discussed in macroeconomics. How a nation's standard of living has changed over the last business cycle. So is the standard of living improving or is it decreasing? We also consider study of inflation and interest rates. So just to give you a perspective, micro is study of a consumer as well as the firm. Macro is study of state as well as means province as well as national economy. Now, in an economy, there are three main decision makers: consumers, firms, and government. So these three participants interact with each other and they cause changes in an economy. So consumers interact with firm, so consumers buy stuff from firm, so they are responsible for sales and profit of a firm, and firms are responsible for employment of those consumers. So individuals are employed by the firm and individuals pay for product of the firm, right? So this is how the interaction between a consumer and a firm work. Same way, government also employs consumers, government also gives orders to certain firm, as well as government taxes consumers and government tax firms also. So they have a complex relationship and this relationship impacts our economy. So demand and supply, when you study microeconomics, demand and supply is important. So interaction between demand and supply leads to market equilibrium in the economy. What is market equilibrium? Market equilibrium means there is no oversupply and there is no over demand. So demand equals supply, that is market equilibrium. So in our discussion we were discussing about iPhone. So the price of iPhone at which those who want iPhone get it, and Apple produces those many iPhones that it wants to sell. So this is a very ideal scenario. Market demand, consumers all purchases of goods and services that determines demand, and market supply, supplies of goods and services. So law of demand and law of supply. So if prices, what does it mean? If prices go up, what will happen? Suppliers will start producing more because they want to capture this price rise, they want to profit from this price rise. So what will happen? There would be oversupply. If prices go down, consumers will want to buy more and more people will start buying. So what will happen? There will be over demand. So if prices go up, there is oversupply. There is prices, if prices goes down, there is over demand. Example would be real estate. If real estate prices are rising, what happens? A lot of construction companies start building real estate properties because they want to encash on this high price. So there would be a lot of suppliers, but consumers will stop buying it. For example, what is happening in Toronto or Vancouver, the prices are so high that people are discouraged from buying properties there. Okay, and if prices start going down, suppliers will stop supplying because they don't want to be in losses. They have to cover their construction cost, but the demand from buyers will start rising. So this is an example. So what does law of demand say? As the price of product rise, the quantity demanded falls. As the price of product falls, the quantity demanded rises. Law of supply says as the price of product rises, quantity supplied rise, and as the price of product falls, the quantity supplied falls. Next is macroeconomics. Macroeconomics consists of studies like gross domestic product. So what is gross domestic products? Value of all goods and services that are produced within Canadian borders in one transaction year. It is called as gross domestic product. So currently gross domestic product of Canada is around 1.7 to 2 trillion dollars. So we are producing goods and services worth $2 trillion in one calendar year in Canada. Now, how do you measure gross domestic product? So there are two basic approaches, income approach and expenditure approach. Income approach means you calculate incomes of all companies that are producing goods and services. So the logic is, if you're spending on something, someone is getting that money. So your spending is income for some other person. So if you calculate all the income, it equals all the spending that happens in economy. So income approach adds all the income that is generated by all the players in an economy. Expenditure approach calculates all the spending that is done in an economy. Now, ideally, income approach and expenditure approach should give the same result, because if you're spending, someone is getting income. If someone is getting income, someone is spending. So it should match. More followed approach to calculate GDP is expenditure approach. So what does it measure? It measures the total expenditure in the economy. So who does expenditure? It is consumers who do it. It is industry who does that. It is government who does that. So it calculates consumption that happens majorly by individuals, investments that is done by business, and government spending. So how much is government spending in the economy, and net exports, that is exports minus imports. So GDP in expenditure approach is calculated as consumption, so consumer spending, plus industry spending, that is investments, plus government spending. So where does government spend? On healthcare, on education, on defense, and exports minus import. Now if I ask you a question, how do you increase GDP? How do you grow your GDP? So answer would be either increase consumption. So consumers, if they start buying more, the gross domestic product increases. Either increase investments. So if there are more investments happening from the business side, then the GDP starts growing. Government, if it starts to spend more, then the GDP starts growing. Or if we export more than what we import, so it adds money to our economy. So Long-term growth of economy depends on these three factors. Population growth. So if the population of a country is growing, so consumers are growing. So if consumers are growing, it adds points to your GDP. Rising productivity, it means if your population is getting better trained, so it is able to use its own talents in a better way. So there is good education in the economy, there is good training that is done in the economy, then it also adds points to gross domestic product. Example will be Sweden. So this Scandinavian means Sweden, Norway, all these countries focus a lot on their education. The primary reason for their economies to grow is productivity increase. Then there is technology innovation. So if you spend a lot on technology, one person can produce what 10 used to do. That is the impact of technology. So technology is a major driver for economic growth. So economy grows if your population grows, if the productivity of the population grows through training and education, or when technology changes. You're spending on tech. Now there is a concept of nominal GDP and real GDP. So what is nominal GDP? Gross domestic product is value of all goods and services produced in a country. Now it may happen that price of product has gone up, but we are producing the same quantity. So what is happening? We are still producing 10 iPhones, but the price of iPhone has gone up. So does this mean that our GDP is more product, means our country is more productive now, or it is producing more? Answer is no. It is still producing the same thing. So nominal GDP can be wrong, means can be misleading, because it doesn't consider inflation. GDP can just rise because prices have gone up. That doesn't mean the country is getting any better or it is producing any more. So nominal GDP doesn't consider inflation, real GDP considers inflation. So if your nominal GDP growth rate is 4%, but your inflation is 3%, what is happening? Your GDP is growing by 4%, but 3% of that is due to price rises. Only 1% you have increased in productivity, in production. So your real GDP growth is 1%. So you should be more concerned about real GDP growth than nominal. So nominal GDP is based on current prices or the prices that prevailed in the same year, reflects the change in size of GDP and the impact of price changes. Real GDP corrects the effect of inflation, a better measure for overall performance, a purer measure of changes in the amount of output produced, and isolates the change in output attributed to price change. So this is very important. Now the next concept is a business cycle. Now GDP growth rate, if you see, it doesn't move in a straight line. So there are times when GDP is growing at a faster pace, then it slows down, then it again picks up pace. So what is business cycle? Business cycle is movement of GDP over time. Business cycle is movement of GDP over time. Now it is generally not so perfect. So the figure that it shows, it's perfectly cyclical. It's not that. There are spikes. Generally, if you see the real GDP growth, there are spikes. So different phases are expansion, peak, recession, bottom, then again expansion, contraction, recovery, expansion. So what is happening? GDP was growing, it attained a peak, it got to a new high, then it started to slow down, it started to fall. Again after some time it picked up. Now the moment it crosses the previous high, then the recovery ends and again another expansion starts. So the moment it crosses the previous high, the recovery ends and it starts. So what are the phases? So expansion, then contraction, then recovery up to the previous level, and then another expansion. So I'll go through the different phases. So what is a business cycle? It describes the key feature of each phase of the cycle. So there are different phases: expansion, peak, contraction, trough, and recovery. So what is expansion? Expansion is there is stable inflation and the economy is steadily growing. So inflation is stable and the economy is steadily growing. Now business are expanding. So what happens? Companies start expanding their inventory to meet consumer demand. So expansion means consumers are demanding more and more products. So to meet these demands, businesses are expanding their inventory. So as the businesses produce more, corporate profits increase. So as the profits are rising, the stock prices keep on going up. So it has rising corporate profits and stronger stock market activity. Now unemployment rate is steady. So the economy is working near optimum unemployment rate or unemployment rate is falling. New business startups outpace bankruptcy. So there are more startups than bankruptcies. At peak, so it has achieved a peak, demand begins to outstrip supply and inflation increases. So inflation has started to rise now because there is a lot of demand, there is a lot of heat in the economy and supply is not able to match up. So more demand means more inflation. Wages are rising. Interest rates, because inflation is increasing, to adjust is interest rates rise. So that means falling bond prices and rising interest rates. Business sales are declining because the demand is now at the optimum level, so business is not able to expand further. So business sales are declining and inventory levels are rising. So there is unsold inventory now because the demand is optimum, it cannot rise any further. And finally stock prices fall and general market activity decline. Because of rising wages, the cost of producing goes up, the demand is not increasing, so corporate profits fall and stock prices and stock market activity also goes down. Okay. Contraction. So level in contraction, what happens? So peak, after peak it starts going down, so economy starts going down, the GDP starts going down. Level of economic activity is falling, so level of economic activity decreasing. Businesses postpone capital investments and profit fall. There are more business failures than startups, and consumers spend less and increase savings. So consumers are not spending anything because they're concerned about their jobs, about their economy, so they start saving more. The trough or bottom, bond market rallies as interest rates begin to fall. So what happens when the bottom is reached? So government starts to panic, and to boost the economy it starts to decrease the interest rate so that people will borrow more and spend more. So as its interest rates start falling, bond market rally happens. Inflation falls and stocks rally. So inflation goes down because no one is demanding anything, economy is bottom out. So inflation goes down and stock markets rally. Consumers start spending again, but the investments, consumer confidence is building, so consumer just start spending again. Recovery, GDP returns to its previous peak and business investment rises. Firm increase their production because they're looking at new expansion happening. Layoffs are over, but no new hiring is there because companies are still want to be sure before hiring new employees whether expansion is really there. Unemployment may remain high, wage pressures are there, but inflation is set to fall further. Now, in economics, there are different indicators. Now, what is an economic indicator? Economic indicator help us to predict what is happening in an economy. So whether the economy is doing good or whether the economy is doing bad, that we can infer from an economic indicator. So there are three kinds of economic indicator. Leading indicator. So these indicators change before things happen in an economy. So if a new recession is there, so some indicator would change before actual recession starts. Coincident indicator happen along with the economic changes. So recession is starting, the indicators are changing. Expansion is starting, indicators are changing. And lagging indicator, these indicators change after the fact. So if expansion happen, then these indicators change. Or recession or contraction happens, then these indicators change. So peak and trough before overall economy anticipate. So leading indicators help you to anticipate trends. Coincident indicator gives information about the position of economy, and lagging indicators help us to confirm trends. Okay, some of the leading indicators, so you just have to remember these things, because in exam they may ask that whether it is a leading indicator or a lagging or a coincident one. So leading indicators example are how housing starts, it means amount of houses being built. So this is a leading indicator. Manufacturer's new order, the amount of new order that a manufacturer gets. So if expansion is happening, what will happen? Construction companies will start producing more before the expansion happen, or customers will start giving orders. So manufacturers will get orders, but they have not produced yet. So manufacturers new orders are also an leading indicator. Commodity prices. Now commodities are used as raw material. So if a recession hits, the demand of commodity goes down. If an expansion is supposed to happen, so people would need final goods. When expansion happens, there would be demand for that. So what would happen? Before the expansion happen, the raw material prices will go up because the demand for raw material will go up. Average hour worked per week, so amount of work that is done per week. Stock prices and money supply, all these are leading indicators. Coincident one are personal income. So as companies start doing well during expansion, they will start paying you more, so personal income rises. Gross domestic product is a coincident indicator. Industrial production is a coincident indicator. So amount of final goods produced is a coincident indicator. And retail sales is also a coincident indicator. Now lagging indicators are unemployment, inflation rate, labor cost, private sector investments, and business loans. Now whenever we discuss recession, we generally look at three things: depth, how much deep it is going, how much economy is going down, how much economy is contracting; duration, so is it lasting for 1 quarter, is it lasting for 2 quarters, is it lasting for few years; and diffusion, so is only one sector impacted, or are all sectors impacted, or which sector is not impacted. So how diffused is the recession? Now labor is important. So we have seen that amount of population you have, that determines your productivity and that determines your gross domestic product. So labor is important. So population is divided by Canadian authorities into three things. People who are unable to work, they are not part of labor force. So who are unable to work? So people who are in psychiatric hospitals, people who are in correction facilities, these are not working. So these are unable to work. So they are not a part of labor force. Then not working by choice. So full-time students may not work, homemakers may not work, retirees may not work. Discouraged worker is people who have the ability to work but they are not finding jobs for long time, so they have been discouraged and they have stopped looking out for work. So people who were looking for the work in past, but because of some factors they have got discouraged and they are not actively looking for work anymore. Then there is labor force, people who are working and people who are not working but they are looking for work. So what is our labor force? People who are working as well as people not working but looking for work. Now, economic performance directly affects the labor market. So indicators are labor force, the sum of working age population who are employed or unemployed. So people who are working as well as people who are not working but looking for work. Participation rate is the percentage of working age population in the labor force. So out of the entire labor force, how much population is working age? So working age in Canada is around 14 years. It's yeah. So population that is considered as working age in Canada is 15 years plus, not 14, it is 15 years plus. Okay. Unemployment rate is the percentage of labor force that is unemployed but it is looking for work. Now, there are three types of unemployment. So within unemployed people, there are three types of unemployment. Someone is cyclical, so it fluctuates with business cycle. So during expansion, there is a lot of production, so there are more people required, and the unemployment rate is low. During recession, there is means companies are not producing so much, so the unemployment rate is high. Then there is frictional. Frictional means this is because of normal labor turnover. So you may have left a job and you are joining some other job, but you are taking some downtime. So this downtime is considered as frictional unemployment because it's a normal day-to-day course of thing. So you may have proper skills to find a new job, but you are just waiting for it. Structural means when something is wrong in the economy. So if the jobs are changing because of technology but the labor force is not changing, then what will happen? They would be unemployed because of their skills. This is called as structural unemployment. So when individuals can't find job due to outdated skills, it's called as structural. So is 0% unemployment possible? So it is not possible. The answer is no, it is not possible, because there would be some people who would not work, right? There would be seasonal employees, there would be seasonal industries and all those things. So 0% of unemployment is not possible. Okay, next is interest rates. So interest rate for a business owner is component of cost of capital of production. So what happens, as a business person you require money to do your business. This money you borrow from banks, financial institutions, as well as from markets. Now the interest that you pay on these borrowing, it is cost of production for you. For consumers, it is price of credit. So whenever you buy something on credit, whatever interest rate you pay, whatever interest you pay on that credit, that becomes cost of consumption. Now interest rates vary according to term of loan. So if the longer term, more would be interest rate, shorter term, less would be interest rate. Conditions of loan, so if you can prepay a certain loan, interest rates would be higher. If you cannot prepay a certain loan, they may not charge that premium. Credit worthiness, so if two companies are borrowing, One is a well-known company like Apple, and one is a very new tech startup. So there is more risk for an investor to give money to the new company. So what will they do? They will start asking more interest. So how do interest rates impact an economy? So higher interest rate increases the cost of capital for business and leads to lower business investment. So if interest rates are too high, businesses will not spend to expand because they're afraid of borrowing, because they have to pay that interest. It discourages consumer spending on durable goods and other commodities. So if you can't take credit, you will stop your consumption and may lead to general economic slowdown. So if interest rates are too high, it is dampening to economy. Determinants of interest rates: basic demand and supply of capital. So if there is more demand, interest rates tend to go up. If there is more supply, interest rates tend to go down. Default risk: if the country is political situation is unstable and the country can default, example for Venezuela, that it already it's defaulting. So what would happen? Any new debt that Venezuela is taking, that would come at a premium, that would come at a higher interest rate, because investors are afraid of not getting their money back. Then central bank activities and credibility. So it also depends on that, how is the central bank proceeding. Foreign developments like interest rates and exchange rates. So if your country is offering interest rates at 4%, but a equivalent country that has the same risk is offering interest rate of 5%, capital will flow there. As well as inflation. So inflation also has an impact on interest rates. So what is inflation? It is a generalized sustained trending rising prices. What is generalized? It is price of all goods and services. So if, for example, all prices are constant, but there is a sudden rise in milk price because of, let's say, supply management goes away in let's say Canada, and the prices go up, right? What would happen? That is not inflation, because only one product is impacted, all products are not impacted. So inflation is generalized and sustained. So if there is a sudden spike and it comes down again, so that's not inflation, it should be sustained. Usually an indication of growth in money supply. So it indicates economic expansion because prices are going up because of demand. So if demand is more, price will go up. So that indicates economic expansion. It indicates increase in demand without corresponding change in supply. It can lead to investor demand a rate of return that protects them from erosion of purchasing power. So if inflation goes up, every investor will start demanding more returns because products are getting costlier. So to keep in tune with those price rises, you would start demanding more returns. It creates a pressure on wages and other variables. So rise of interest rates are very bad for economy. Hyperinflation is very bad for economy because people are discouraged from spending. Inflation and consumer price index. So inflation is nothing but we use consumer price index for measuring inflation. So what is consumer price index? So a country creates a basket, it puts goods and services in that basket. So how does it decide which goods and services are part of that basket? It tries to estimate for a normal person to live in that country what is required, and all of that is put into a basket, and then it tries to track prices of that basket. So that is called as consumer price index. Okay, tracks the retail price of basket of goods to reflect typical consumer spending, measures the average price level of consumption bundle, Compare CPI in current period relative to the base year to arrive at inflation for the year. So base year is 100. So base year is 100, that was decided in 2002. So base year for us is 100 and the year is 2002. So what we do is in 2018, how much costly are goods and services as compared to 2002? So that gives us current inflation figure. Subtract previous year's inflation figure from that and you get how much goods and prices of goods and services have gone up in the year. Cost of inflation, it erodes standard of living for those who have fixed income. For example, if you have retired and you're just getting, let's say, $5,000, a fixed amount every month, but prices of goods and services are going up. So what will happen with that same $5,000? You would be able to buy less and less. Erodes purchasing power or forces investors to demand higher returns. Higher interest rate slows growth because if inflation is high, so inflation interest rates go up to counter that inflation, that slows down growth. Increases the cost of debt for individuals, corporations, and government. So what is output gap? Difference between real GDP and potential GDP. What is potential GDP? What the economy is capable of producing when its existing input, capital, and technology are fully employed. So if we use everything to best of our abilities, that would be potential GDP. Real GDP will be what we are doing right now. Difference between that is output gap. So negative gap when actual GDP is below potential, and positive gap when actual GDP is above potential. Okay, now how does it relate? When companies continue to operate above capacity, they raise prices in response to this demand. So this is called as demand pull inflation. So demand pull inflation means company are operating above capacity. So what do? They try to capture this and they raise the prices. So this is demand pull inflation. And scarcity of resources can lead to inflation, that is called as cost pull inflation. So two factors due to which inflation is there. One is because of over demand, that is demand pull, and one is because there is scarcity of resources, there is not much production, supply is low, that is cost pull. So demand pull and cost pull. Now inflation can be negative, that is called as deflation, or inflation rate can keep on going down. So prices were rising at 5% but prices are now rising at 4%. So that is inflation rate has gone down. Inflation rate going down is disinflation, and inflation becoming negative, so prices becoming cheaper, is deflation. A decline in rate at which price rise is called as is the decrease in rate of inflation. Prices are still rising but at a slower rate. It is captured through Philip curve and sacrifice ratio. So you don't have to be concerned about it, but these are the terms that are used to, means these are the things that are used to capture disinflation. Deflation is a sustained fall in prices. The annual change in CPI is negative year after year. Deflation is just the opposite to inflation. Problem: sustained falling prices could lead to decline in corporate profits because prices are going down, so companies are making less and less profit every year. The external sector. So we are also concerned in economics about what is happening outside the country, because export account for a significant part of Canada's GDP. We are a large exporting country. Canadian exports a majority of goods to US and also a significant amount from US it imports. So whatever happens in US, it affects us. So if consumers in United States stop buying products, stop buying goods and services, so Canadian exports will be impacted and our economy would be impacted. If they start buying more, our exports would rise and our economy is impacted. What this means, the performance of Canadian economy is strongly tied to performance of US economy. The balance of payment is used to track the economic transaction with rest of the world. So balance of payment means how much trade and investment is happening in our country and how much trade and investment is our country doing in other countries. That is balance of payment. So how much money is coming in versus how much money is going out. Now money comes in two account, or money goes out from two accounts. One is current account and one is investment account. So current account is the trade account. Whatever goods we export bring money in, whatever goods we import our money goes out. So records the exchange of goods and services between Canadians and foreigners, that is current account. It is part of balance of payment. The earnings from investment income, interest and dividends and net transfers such as foreign aid, all of these are considered as current account. Deficit implies Canadians are spending more on foreign goods and services than they are selling. So imports are more than export. Surplus means we are selling more to foreigners than we are buying. Now the next one is investment or capital and financial account. It records the financial flows, that is investments in Canada done by foreigners as well as investments Canadian do in foreign countries. So financial flows between Canadians and foreigners related to investments by foreigners in Canada and investments by Canadians abroad. When a country runs, this is important, when there is a trade deficit, when you are importing more than you export, so you need money. So where does this money come from? From other countries. So a deficit in current account is generally countered by a surplus in capital and financial account, and a surplus in capital and financial account leads generally is countered by deficit in. So a surplus in current account is countered by a deficit in capital and financial account, and a deficit in current account is countered by surplus in capital and financial. So both of these are opposite. So when a country runs current account deficit, the shortfall is financed through selling of assets or borrowing fund. So selling asset means money is going out, money is coming in, and borrowing fund means money is coming in, foreign money is coming in. So this is how it works. Both these activities are captured through capital and financial account. Now exchange rate is also important. Why is exchange rate important? So I'll give you an example in Excel. So let's say BlackBerry is a Canadian company. Okay. Now BlackBerry has, let's say, model 1. I'm just making stuff up. So it has model 1 that sells at $1,000, 1,000 Canadian dollars in Canada, and the exchange rate currently is 0.75. So 1 Canadian dollar is equal to 0.75 USD. So how much does it sell in United States? So this model 1 sells in United States at $750. Now what is happening? Nothing is changing. So product is still sold at $1,000, but this exchange rate changes. So instead of 0.75, this exchange rate goes to 0.85. What will happen? Model 1, which was selling at $750, the price of that model will go to 0.85 into 1000, that is 850. So as the exchange rate changes, the price of goods and services goes up and down. So if exchange rate is going up, that is bad for exporters in Canada. If this exchange rate goes down, so it goes to 0.65. What will happen? This BlackBerry will start selling at $650 in United States. So there will be more demand, right? If it sells at 850, there will be less demand, and the base price was 750. So exchange rate, the decrease in exchange rate, the depreciation in exchange rate is good for exporters. Appreciation in exchange rate is bad for exporters, and the other way around for importers. So the external value of nations' currencies impact the volume of trade. As the Canadian dollar rise in value against the trading partner, the volume of exports fall and the volume of import rise. So as Canadian dollar becomes strong, exports are suffered and imports rise. As Canadian dollar falls in value, export rises and import goes down. What is exchange rate dependent on? The exchange rate is dependent on inflation differentials. So whichever country has higher inflation, their currency depreciates. Interest rate differential, so it depends on interest rates too. Whichever country has higher interest rates, fund will go there, so their currency will appreciate. Current account, so whether you have current account surplus or deficit, that would determine the interest rate, the exchange rate. Economic performance of countries, public debt and deficits. So if the country is running deficits for long, the currency starts depreciating. And political stability. So exchange rate is dependent on a lot of these factors. So that's it for today. Hello and welcome. So in this recording, we are going to discuss chapter 5, the economic policy. So economic policy in general, policymakers use information about inflation, unemployment, GDP, interest rates to formulate policy to keep the economy on a long-term stable growth path. So governments get a lot of inputs about inflation, about unemployment, about gross domestic product, interest rates. So taking all these inputs, they try to formulate a policy that keeps the economy stable. So if economy is getting overheated, they will try to calm it down. If economy is underperforming, they try to boost it. However, we do not know that recession occur, that growth is sometimes stronger or weaker than expected. So the thing is, governments are not able to exactly control economy. So the end result would be quite different than what was intended for. So there are two major influencers: Department of Finance, that is federal government of Canada, and then there is Bank of Canada. Federal government does fiscal policy, Bank of Canada does monetary policy. Fiscal policy means Government of Canada tries to influence government spending and taxation, and monetary policy means Bank of Canada tries to control money supply. There are two economic theories, Keynesian theory and monetary theory. Keynesian theory says that use of both fiscal policy as well as monetary policy is okay in an economy. So if economy is overheating or underperforming, governments can use either fiscal policy or monetary policy or both to influence it. Monetarist theory says that they should not be using fiscal policy, they can use monetary policy. So fiscal policy deals with a role of government in the area of taxation, government spending and government borrowing. The main tool of fiscal policy is annual federal budget that happens in the month of February. The budget contains projections for coming years in area of spending, revenues, the deficit and debt. So it decides where and how much the government spends, how much the government taxes to get what are the different taxes and how much will it tax to get the get its revenues. Then how much is spending versus revenue, that is deficit or surplus, and if there is deficit, how much debt it will issue to cover that deficit. Deficit is mismatch in spending and revenue. So if you see Canadian fiscal policy, we had huge deficits since 1970s till 1980s, right? And after 1980s, due to prudent fiscal management, we started to decrease that deficit. Now again the deficit has started to increase, but it is much below the levels at which it was in 1970s and 80s. So there are three possibilities. There can be a surplus. Surplus happens when government income through taxation is more than government spending. Deficit happens when government spending is more than government income. Balanced is spending and income are equal. Fiscal policy can impact the economy in many key ways. So governments can decide where to spend, how much to spend, that impacts us. For example, if government decides to increase the CPP payments, Canada pension payments, so all the pensioners will start getting more pensions, so they would start spending more, so that influences the economy. It also can decide how taxation works. For example, sometime back in United States decreased the business taxation, so it encouraged business to expand and to spend. So government means businesses in the United States are spending more on capacity building. Bank of Canada is the other entity that regulates the economy. So it regulates credit and currency. Credit means how much borrowing is there. It can increase the borrowing or decrease it through interest rates. And currency, so how much currency is there in the system. Now currency is different. 92% of currency is non-physical, only 8% currency is physical in the world. So it tries to influence how much digital as well as physical currency is there. It controls and protects the external value of dollar. So unlike few countries that currency is fixed, means exchange rate is fixed, Canada has a floating exchange rate. So our exchange rate depends on demand and supply of our currency. So Bank of Canada generally does not intervene in exchange rate markets. So it is free float, it is market related. But if there is sudden appreciation or depreciation in currency, and that is bad for our economy, only then it intervenes. It uses monetary policy to reduce fluctuation in prices, employment, trade, and protection. It promotes the country's economic welfare. So Bank of Canada promotes country's economic welfare. It also manages fund for Government of Canada. So it handles fund for it, and it regulates the financial system. So all the banks, all the financial markets that are there in Canada, so it tries to work with them, it tries to work with different regulators, and it tries to influence them. Functions of Bank of Canada: to issue banknotes, act as a government's fiscal agent, so handle government money, investments, control the clearing system. So if two banks are trading with each other, Bank of Canada is responsible for clearing and settlement of those funds. Lender of last resort, so once everyone has stopped lending, Bank of Canada is the lender of last resort for banks. Maintains orderly conditions in financial markets, but the most important function of Bank of Canada is to conduct monetary policy. So one part of monetary policy is through influencing interest rate. How does it do it? Cash management. So it tries to control how much money is there in circulation. If there is a lot of it, if it increases the money, interest rates will go down, because then there is a lot of money. So I don't have limited borrowers, I can borrow from a lot of players, so interest rates tend to go down. Or it can shrink money so that only few suppliers of money are there, so interest rates will go up. Open market transactions is buying and selling, that is lending and borrowing funds and trying to influence interest rates, as well as setting the interest rates, also changing the bank rate. So monetary policy is the most important role of Bank of Canada. Objective of monetary policy is price stability, that is growth without inflation. Goals for maximum increase in CPI, inflation control. So Bank of Canada has a target between 1 to 3%. So it wants to keep inflation within this range. If inflation is too low, it tries to increase it. If inflation is too high, it tries to decrease it. The goal is to keep it in middle of the range. Monetary policy, the moderate growth in money supply leads to moderate growth in the economy and modest inflation. Thus monetary policy is management of growth in money supply. So this is interesting and important. So either the economy is doing very low or the economy is doing very well. So when economy does very well, everyone is buying, so there is a lot of consumption. So what happens, it leads to a lot of inflation. So demand is more than supply. When economy does well, there is high inflation. So what does the bank want? Bank wants to slow down the pace of demand. How does it do that? It does it by controlling either interest rates or money supply. So it will raise the interest rate. So if it raises interest rate, people will stop borrowing, people will stop taking credit purchases, and they will start saving money. So what happens? Borrowing becomes expensive and consumption and business investments decrease. Other way to do it, it tries to reduce the money supply. So only few suppliers are there. So the few suppliers, because supply is less and demand is more, they will start charging more for their funds. So interest rates rise because of it, borrowing becomes expensive, consumption and business investments fall. If there is recession and unemployment in the economy, demand for goods and services is lower than supply, which causes the growth in economy to decline. The bank wants to stimulate spending to increase demand. So when economy is not doing so well, there is no demand, bank would try to increase the demand. Now how does it increase the demand? Two ways again. Lower the interest rate so that people will start borrowing more, so they will start buying more. So lowers the interest rate. So lowers the interest rate, borrowing becomes more affordable, consumption and business investments increase. Or it can increase the money supply, so it can increase the supplies of money, so you have more options, so interest rates will fall, borrowing is affordable, and business and consumption and business investments rise. So next, now overnight market is important. What is overnight market? So what is a bank's role in this financial system? So the major important bank role is to take deposits and give out loans. Now if bank is taking $100 as deposit, it cannot lend out entire $100. Some part of it has to keep at reserves. So let's say I'm Scotia Bank and I did not get much deposits in the day, but I gave lot of loans in the day, right? So at the end of the day, my reserves have gone down. So to continue operating, I need more funds. So what do? I borrow it from some other bank. And let's say I'm RBC. I had lot of deposits in the day, but I did not give out much loans. So what has happened? I have additional funds now with me. So I would try to lend it. So overnight market is a marketplace where banks lend and borrow from each other, and majorly it is done to fulfill the reserve requirements. So Bank of Canada tries to influence the overnight market. Overnight marketplace is where financial institutions lend each other money on a overnight basis. When Bank of Canada changes the target for overnight rate, other short-term interest rates also usually change. Bank of Canada established a 50 basis operating point for overnight financing. Bank rate is set at the upper limit of operating band. So changes in operating band indicates an easing or tightening of monetary conditions. Each day, Bank of Canada targets the midpoint of the band. The changes are announced by press release. So what does this all Greek mean? So I'll open an Excel sheet and try to explain. So periodically, Bank of Canada tries to give out target rate. What is target rate? Target rate is rate at which overnight borrowing and lending should work. So let's say target rate that Bank of Canada has decided is 4%. Now, Bank of Canada knows that banks may want to borrow a little lower, or banks may want to borrow a little, means may want to lend at a little higher rate. So it allows a certain range to function. So that range is 50 basis point. Now what is basis point? 1 basis point equals to 1/100%. So 50 basis point means 0.5%. So Bank of Canada would not intervene if the lending and borrowing works in range of 0.5%. That is 0.25% up from the target rate and 0.25% down from the target rate. So 0.25% up means 4.25 and below is 3.75. So this is the range. If borrowing and lending starts to happen at very lower rate, bank would try to increase the rate so that it goes back to target. If it happens at a higher rate between banks, Bank of Canada would try to reduce it to target rate. So when the rate goes above this or below this, Bank of Canada tries to influence rates. Now how does it do it? So let's read. So it does SPRA and SRA. So what is an SPRA? SPRA means Special Purchase and Resale Agreement, and SRA means Sale and Repurchase Agreement. So Special Purpose Resale Agreement, Special Purchase and Resale Agreement, and Sale and Repurchase Agreement. So we'll discuss what is that. So open market operations. So the policy is aimed at direct impact on demand of credit in the economy. When would bank use SPRA and SRA? So let's see. When does it use SPRA? It uses SPRA when overnight money is trading above the target rate. So when money means banks are lending and borrowing at above the target rate, it uses SPRA. The objective is to relieve upward pressure on overnight rate and reinforce the upper limit of target. Why does it do that? It may dampen the economic activity by lending to higher short-term rates across the entire spectrum. So it doesn't want the interest rates to be too high. So if interest rates are becoming too high, it does special purchase and resale agreement. How does it do it? So BOC buys short-term securities from primary dealers. The securities are then sold back at predetermined price the next business day. So what is effectively doing? BOC lends to financial institution at the top end of the target. So if a financial institutions had need to borrow overnight, the preference is to borrow at a lower rate than what is prevailing in the market. BOC becomes an alternative to borrowing from other lenders. This gives short-term rate. This results short-term rate going back to target. So I'll explain, don't worry. It seems very daunting, it's very easy. So let's say our range was 4%, 4.25%, and 3.75%. Now what has happened? The current rate that is banks are borrowing and lending at, it is 4.50, right? So the target rate was 4 and the allowed range was 4.25 to 3.75. But the current borrowing and lending between banks is happening at 4.5. So is it outside range? Yes, it is outside range. So banks are borrowing at a higher interest rate. So this may cause interest rates in the market to go up. So what would Bank of Canada do? Bank of Canada would start lending at 4.25. So what would this do? So if I am Scotia Bank, in the market rate is going on 4.5. So if I lend from market, if I borrow from market, the current rate going on is 4.5%. But I have an option now. I can borrow it from Bank of Canada, which is charging me 4.25%. So what would I do? I would start borrowing from Bank of Canada. So everyone starts doing that. So what happens to rate? The interest rate goes down. This is called as SPRA, Special Purchase and Resale Agreement. Okay, lending at the lower rate than market. SRA, when it is done where overnight money is trading below the target rate, it relieves downward pressure on overnight rate and reinforces target, may lead to lower interest rates through. Why it is done? Because if interest rates are so low, it may lead to lower interest rates again and it can create inflation. How does Bank of Canada do it? Bank of Canada offers to sell securities to primary dealer. The securities are bought back at predetermined price. So things to remember. In SPRA, BOC buys securities. In SRA, BOC sells securities. So first sell, then buy. In SPRA, first buy and then sell. So what effectively it is doing? It borrows fund at the lower end. If FI has need to lend overnight, the preference is to lend money at a higher interest rate. This drives up short-term interest rate back to target. So coming back to this example, so delete this, delete this too. Now let's say this was the target. Interest rate going on in the market right now is 3.25%. So banks are lending and borrowing from each other at a very low interest rate. So banks wants to increase it. Bank of Canada wants to increase this rate. So how does it do it? It starts borrowing funds. So it starts borrowing funds and pays. Bank of Canada starts paying, that is it borrows fund at 3.75. Now I am RBC, Royal Bank of Canada. I have extra funds with me. One option is I can lend it to Scotia Bank at 3.25%, that's the market rate, or Bank of Canada has just come in and it is offering me 3.75. So what will happen? RBC will start lending it to Bank of Canada. So what would happen to interest rates? Interest rates would jump up. Okay. So once again, things to remember. SPRA is done when interest rates are above the upper margin. It is done by buying and then selling. SRA is done when interest rates are below the lower margin. It is done by selling and then buying. SPRA reduces upward pressure. SRA reduces downward pressure. Also, it can change the target rate. So target rate is set by Bank of Canada. So instead of doing buying and selling, it can just set the target, set a different target rate. So direct influence, it sends a message to all market participants. Bank rate is minimum rate of interest that BOC charges on short-term loan. So set at upper limit of bands operating band for the overnight lending rate. Cash management. So it also does these two things: large value transfer and drawdown and redeposit. So what is large value transfer system? So each day billions of dollars flows through Canadian financial system. So settle transaction between different banks. These transactions include wires, checks, wire transfer, direct deposits, etc. So to facilitate transfer of these payment, bank has established something called as large value transfer system. So what is that? Instead of doing each transaction between banks, they net it. So instead of if I am transferring some funds from Scotia Bank to RBC, so instead of transferring funds again and again, it is all done through internet and it happens directly. So large value transfer has been facilitated because of technology. Then next is drawdown and redeposit. So a drawdown is transfer of deposits to the bank from chartered bank. So what it does, it takes money from other banks. So it is transfer of deposit to Bank of Canada from other banks. That is drawdown. So it draws money. It is calling money back. So what it does, it starts offering higher interest rate than the market. So all the money flows back to Bank of Canada. So it sucks money out of the system in drawdowns. Redeposit is transfer of money from Bank of Canada to other banks. So it will start giving out funds, so the amount of money in the system increases. Drawdown is money is called into Bank of Canada, and redeposit is Bank of Canada gives money to others. Now the challenges with government policy is time lags. So if you change something, it doesn't have effect right away. It will take quarter, a half year, or maybe years to have impact. Policy consideration, political consideration. So political consideration is, let's say I have elections coming up. I'm a ruling party in Canada and I have elections coming up. The economic situation dictates that interest rates should, means the taxation rate should go up. I'm in a very bad fiscal situation, so I have to increase my taxes. But because elections are coming up, that will be a political suicide. People will not vote for me. So what I'll do, I'll decrease the taxes when I had to increase them. So political considerations are there. It's not only economics. Future expectations. So future expectations are important. So even if Bank of Canada increases interest rates or decreases interest rates, consumer may not start buying right away. He may think that, okay, there are some other factors that are influencing my decision apart from interest rates, so it may not have an impact. So future expectations matter a lot. Now this is a major factor in, at least in Canada. Coordination of federal, provincial and municipal policies is very difficult. So we have different provinces. So one province may have expansion happening while other province may have recession happening. For example, Ontario may have expansion happening and Alberta may have recession happening. Now Alberta wants interest rates to go down to boost its economy, but Ontario cannot afford interest rates to go up. So it is very difficult to coordinate between federal, provincial, and municipal policies. Then high federal debt. So federal debt keep on increasing. So federal debt, if it increases, it decreases the future income of a country. And impact of international economies. We do not work in isolation. We are impacted by the world, and majorly we are impacted by United States because it is our largest trading partner. So whatever is happening in US economy, it impacts us. So that consideration also has to be given. Now this is an extract I have directly picked from the textbook because it's important to read. So if unemployment and recession is happening, so what would Bank of Canada try to do or government try to do? Both of them will try to increase consumer spending and investments with expansionary policy. So fiscally, Government of Canada will increase government spending and decrease taxes. Bank of Canada would increase money supply and decrease interest rates. If inflation is high, the economy is overheated, we have to reduce the demand. So reduce consumer spending and investments with contractory policies. So Government of Canada would decrease government spending and increase taxes, while Bank of Canada would increase money supply, would decrease money supply so that we have less money and increase interest rates. Now, what are advantages and disadvantages of monetary policy and fiscal policy? Monetary policy that is done by Bank of Canada, the advantage is the effect on economy may be more immediate. So monetary policy works right away. Except taxes, fiscal policy takes time to work. So government spending, okay, so we'll go through advantages first, disadvantages first of monetary, then we'll come to fiscal. So effect is right away. The initiative, example, lower or higher interest rates can be reversed. So it is easier to reverse. It is independent of political consideration. So Bank of Canada is an independent body. It is independent from Government of Canada. So it is an independent consideration. So there are no politics involved usually and hopefully. Disadvantages, it can be difficult to target a specific region. So same thing, Alberta may be in recession, Ontario may be in expansion. So if you do one, the other province gets damaged. Lowering interest rates may not have an impact if consumer doesn't feel confident. So even if interest rates are going down, consumer may decide not to buy. If interest rates are already very low, lowering them will not have any impact. Fiscal policy that is done by government. Advantages, government spending can be targeted to specific regions. So we can have policies focused towards Alberta. Ontario can have policies focused towards them. Tax cuts and increased benefits are popular. Consumers can more easily understand and experience the impact of fiscal policy. So they may find it difficult to understand monetary policy. Disadvantages, taxes increase and government spending cuts are unpopular. So reverse way, if you have to control the economy through fiscal policy, it's very unpopular. There are challenges in stopping a project once it has been implemented, even if initiative is no longer necessary. Once you start something, it's very difficult to stop. And a higher government spending can raise debt levels and lead to a greater proportion of our income going towards interest payments. That's it. See you in next recording.